Welcome to another episode of Commercial Property Roadshow. You're here with Helen Tarrant, and today I'm going to cover one of the most important risks in this current market, and this is market risk, yields, and return. So it's sort of my risk before 4 and 5. 4 talks about market, number 5 talks about yields and returns. They're interrelated, so I'm going to do this video. I'm going to cover both of them. I'm going to show you some returns. I'm going to show you the comparisons, so you get to see and just get a feel of it. Unless you're doing this, living and breathing this like we do and our whole team does, it's hard to pinpoint. Unless you're a value, it's hard to pinpoint. But if you're spending, all day searching on Google, all day looking up at properties and real commercial, you are unlikely to find out what exactly is the yield. Because remember, there are multiple metrics: the type of tenant, the type of lease, the location, plus the type of building, whether strata, freestanding, future development potential or no potential. All of that makes what the return is, and then how do you compare it with something else as well? And what is your final decision, and what risk do you want to take? And also, one of the most important risks in this market that you've got to avoid, and this is where if you don't have a buyer's agent who can tell you this, then you need to find another buyer's agent, or you can be with someone who is totally educated across the board and someone who wants to work in partnership with you to build a long-term portfolio. So one of the things that we're looking at, and they should be able to tell you this exactly what area, what type of property should be getting, what kind of returns, right? Not just what kind of warehouses or office space, but what if the metrics change? What kind of returns should you be getting? And I can show you some examples. That's what today is about. It's about exploring, so well, let's go on a map so you get to see it, right? And what you really need is someone where you can talk to them and say, hey, in Adelaide, what are we getting in that return? Or, we're going to be in central New South Wales. What kind of return are we getting there? Or potentially inland Queensland. What are the right returns? Look, the market is changing. The market is shifting pretty fast, but also it means that you need to keep your finger on the pulse when you're looking at property, especially if you're trying to do this on your own. And if you're not trying to do it alone, partner with someone who's willing to grow your portfolio with you. So let's go and let's check out some of these different properties. So one of the things is, the first thing I'm going to start out is showing you a map, right? I'm going to show you this Google Maps. Why am I showing you Google Maps and why am I showing you Brisbane? It doesn't really matter. So I can take you through here. So pretty much as a buyer's agent, we cover everything on anywhere from Cairns all the way down to Melbourne, Victoria, across to Adelaide, South Australia, and also we look at property deals in also Tasmania here and there, and we also sometimes look at deals in WA as well. But this is our strip, right? At the moment, right now, we're sitting on deals in Brisbane, in Sydney, in Melbourne, in Adelaide, as well as ACT. So we are across 5 major cities and states right now as a company. So we have our finger on the pulse all around here. But one of the things that's important is we want you to zoom in. So let's just, for example, take Brisbane, because it is the hottest market at the moment in this market, right? It's the hottest market in this current heated market, right? Everything else is a little bit dulled, but Brisbane is really, really heating up. So let's go into Brisbane. So Brisbane, essentially, when I look at the Brisbane Metro, I like to look at this strip, which is Gold Coast all the way to the Sunshine Coast right here. And if I hone in, and I hone in on somewhere like a Brisbane, where do you start with something like this? Well, the simple thing is, let's go to Brisbane Metro. So Brisbane Metro is going to be somewhere here, where that red little dot is. So that's your Brisbane Metro, right? Brisbane Metro is characteristic by the center of the town, the CBD, but also really where it is in relation to the airport as well. So what we're seeing at the moment here is that properties around the airport, either way of the airport, where it's freestanding properties are demanding the lowest type of yield. So they're probably at your 5s. Properties around the airport that are till slab warehouses, we're seeing at about 5.5%, maybe to a 6%. Now, as you travel out from the airport and you're heading towards the city, there's 2 rings that would overlap over here. Right, so there's 2 rings that would overlap over there, and what you would see is that those are the yields are starting to come back up to probably around your 6s. At Chermside, Astley, which is sort of like your this is where your suburbia comes in. So if you're in Sydney, that's like your Hills district. If you're in Melbourne, that is more like you're probably around your Glen Waverley areas, a little bit like that, around the areas around there. And then what we're going to do is then we're going to look at areas like that. We're heading towards the Sunshine Coast up. We're seeing that 6% or just shy of that 6%. Now, then we're coming to the other side where we're really heading inland, and this is where the yield starts to change. This is where the yield starts to change, because as you head inland, you'll be able to see that these are the changes we're seeing inland. So firstly, as we head inland into Ipswich, where you are seeing right now in Brisbane, you are going to pick up an extra 0.5% or 1% in Ipswich. So if you're seeing about 5.5% in terms of your warehouse, you're seeing your 6.5% in your Ipswich area, because there's more inland, which means that as you go even more inland into the more remote regional areas, and we're talking about maybe at Gatton, we're talking about areas that's in, we're moving towards your Toowoomba areas here, you're seeing that the yields should actually be picking up here. So if you're buying around this area, around that, this whole area, it should be around the 7s. So you should be in this area at the 7s. You shouldn't be accepting anything that's lower than 7, unless, of course, you have a development potential. So this is the area here where we're going to see your, we're seeing Laney, we're seeing Woodlands, we're seeing Gatton, we're seeing different, like, we're seeing different areas like Lawes and Forest Hill. We're seeing this area where it's small pockets of population, but not large enough to be a town, but quite interesting. But then, interestingly, when you go to Toowoomba, what you see there is that you're seeing the yields compress as if it is a Brisbane return. So in Toowoomba, we're seeing your 6%, right? So the interesting thing is, where people overpay and where you're at risk is that you are looking at Brisbane yields, or where we're coming down here and you're in Sydney. So let me go to Sydney. We're here in Sydney. Let's go down. Oh, Newcastle and Sydney. So we're here in Sydney. We're here in Sydney, and Sydney returns of 5% standard across the board right now, and that's if you're lucky, right? Warehouses are 2.5%. So you can't look at a 2.5% warehouse and then look at Brisbane and go, oh my God, it's so cheap. I want to go to Brisbane and I want to buy a 5% yielding property, and I buy a warehouse in Brisbane. Well, what happens there is then all of a sudden what you find is that you've actually overpaid for the property. So where you overpay and where you really are exposed to that risk is you buying the incorrect yields in the different areas. So as things go more inland, you should be getting more returns. If you are paying the same amount of money inland as you are in the city areas, then you've overpaid for that property. And what that means is that you're going to have to wait out your time before you can actually regain the growth on the property, and then you'll have to hold it for a period of time and hope the tenant doesn't change, hope things doesn't devalue, and until the market recovers. So that is your major risk. And I see that happening so much right now, because people are looking from a different city into another city, and their yield and their expectations levels are different, and they're expecting a different kind of return, right? And they're expecting a much lower return where they should be getting a much higher return. And this is why you seek the experts and the professionals in this, because you don't want to be in that situation, right? So anyway, moving forward, let's have a look at a comparison of a property. So I'm about to share with you two totally different properties, right? Firstly, I'm going to share with you this property here. This property is in Ipswich, and we can go back and have a look on the actual map to see what it is. So this property is in Ipswich, right? So if you see this property, it's really a warehouse property. It's a nice and neat warehouse property, right? They're asking for offers over $1 million, which is just shy of probably 6%, probably a little bit shy of 6% by the time you finish with it. Beautifully decked out property. You've got your warehouse component, you've got your office component. It is actually a really lovely kind of property. Now, if we look at where that property is actually located, let's go down there and see the map. When we see what property is located in relation to the city, we're thinking, okay, so the vendor is actually asking quite a high price for the $1 million property, because in Brisbane, if you're buying similar properties, you are probably going to be paying 5.5%, but freestanding, you also pay a bit of a premium, because it's very hard to find freestanding at about $1 million. So here we're in Ipswich. We're also on the fringe of Ipswich as well. So about a 6%. That's what the property is going for, 6%. Now let's compare that with a property in Warwick. So this property in Warwick is a property, and again, a warehouse property. Very neat, very nice, smash repairs here, great blocks of tenants. The full site is being used, a cute little area. You don't have the same quality of building, in the sense that the building is made of more tin sheds of corrugated iron and not as tilt slab as the other one. So the actual structure, but it's very functional and located in very, very fit for the local area. So obviously very, very busy, right? Very, very busy. And we can see everything is being used here as well. So, and this property is on the market for $895 at 8%, right? If we look at this, let's look at this property and where it is located. You can see that here we're in Warwick, and when we zone out, where is Warwick in comparison to everything else? So we're actually quite far away. So if you look at it, the closest town is Toowoomba. From Ipswich, it is actually going to be probably more than an hour's drive from Warwick. So it's inland from Toowoomba. It's further inland from Ipswich. There is going to be more risk investing there. So that is an 8% yielding property in this current market. People ask me, where do I find 7% plus? Well, there you go. I've just found one for you, right? It's at 8%. Now, when you compare both of these, do you say to yourself, well, which one should I buy? Well, the question is not which one should you buy. Which one's actually the right return for that market? Now, the Warwick one at 8%, I think is priced very correctly. I think it's very right because you're actually inland and you're in Brisbane. It is a town that is up and coming, and there's a lot of things happening in the town. The 8% really justifies the return on that property, and I think it's a correct return. Now, Ipswich one, I do think is a little bit light, asking for about 6%. If there's a little bit of a bidding in it because it's that $1 million freestanding, you could get the yield down probably as low as 5.7, 5.75, 5.6s even. I think you've paid the premium and a little bit above for that because it is Ipswich, and you really should be getting 6 towards 6.5 in an everyday market. But even in the heated market, on 6 could be really good. So I think because of where the market is, that it's going to go for less than 6% at the moment. So in that case, I would say someone paid a little bit more than above market, and they paid a premium for perfect stock. And that's what you would do. If you're paying for the hottest stock, which is warehouse, you're paying for good, reliable tenants, you're paying for the lease, and even if it's not in the area of Brisbane, you're paying for it at a different yield. You're effectively paying Brisbane yield in Ipswich. So, for example, you're effectively paying, Sydney Metro North Shore properties pricing, but you're in the western suburbs. That's the equivalent of the analogy, and it's just like being in Melbourne Fringe or somewhere like an Albert Park or areas or an Armidale in Melbourne, but you're really paying somewhere like a Mornington Peninsula or Frankston. You're really paying. You're really getting that kind of returns, and in Frankston, where you should be getting that in Melbourne Metro. So it's more about the incorrect returns, and that's why you're paying more in the market. So not to confuse you, but just to say that really be careful where your market is at this point. In whatever state is different. So Melbourne is experiencing something quite different. Melbourne office spaces, Melbourne retail has really been smashed. A lot of companies have left Melbourne. Melbourne's having these infrastructure challenges at the moment. So what we're seeing with things like that is that Melbourne is actually giving a slightly higher yield than Brisbane, but that's because a lot of the investors have exited and gone to Brisbane instead. So this is a good time for, if you were my client, I will be looking at particular key properties in Melbourne and back into Victoria, but only if it fits your profile, and I have to understand you and what you're trying to build to see if a Melbourne property matches up with you and whether you have long-sustaining holding power to reap the rewards on the back end of that, because they will come back. When it comes back, you'll get a significant kick on your capital growth. So, and of course, Sydney's experiencing something totally different. Sydney, we're expecting very high prices, low returns for warehouse property, but everything else seems to be sort of a bit of a flat line at the moment, and the values are a bit everywhere. So lots of rents have changed over the last 2 years with COVID. As a result, lots of valuations have changed as well. But what we're seeing in Brisbane is this trajectory all the way up, and people are paying higher prices and lower returns in that area. South Australia is going through that gentrification, so there's still lots of ups and downs. ACT is relatively stable, although when everything opens up back up again and towards next year, we're going to get more confidence that that's probably going to give them a boost. So if you really want to align yourself with the right company that is going to do the right thing by you, that is going to tell you the right returns, that's going to educate you on how to be a professional investor in the commercial property space, reach out to me, helentarrant.com, or helen@commercialpropertycashflow.com.au. Don't forget, hit the bell and subscribe, because there's more to come on our inspections in Adelaide next week, and there's more things to come about what to do in the commercial property space right now. But just remember, Watch your yields. Don't pay for the wrong returns in the wrong areas. Watch whether you're buying strata or whether you're paying freestanding, and what are the yield differences. Also, the type of properties change, like whether you're buying office, retail, or mixed tenancies or warehouse. The returns change there as well. Really be careful and mindful of that. Do your research. Goes in eyes wide open, and good luck in your journey. Otherwise, reach out to me and let me help you in your journey. So until next time, happy hunting and keep building that passive income. Bye for now.